Hey everyone, welcome back to Market Meridian. I'm Eric, and today is March 16, 2026, a day that could set the tone for the rest of the week in global markets. If you're new here, this channel is all about cutting through the noise, breaking down complex market dynamics, and giving you the clear, actionable analysis you need to make informed trading decisions. No fluff, no jargon, just straight to the point insights for traders and investors of all levels. Before we dive in, let's take a quick pulse check of where we stand right now, because today is not a business as usual a day. The markets are on edge, and four key assets are driving all the action: gold, crude oil, Bitcoin, and the US dollar. Each of these assets is being pulled by powerful forces: Fed policy repricing, a worsening Middle East crisis, institutional money flows, and regulatory shifts, and they're all interconnected. What happens to the US dollar today will directly impact gold, oil, and Bitcoin. What happens in the Middle East will move oil prices, which in turn affects global inflation and Fed policy. And Bitcoin, which used to trade independently, is now tied more closely to risk sentiment and institutional flows than ever before. Let me give you a quick snapshot of where each asset stands as of 11:20 a.m. Eastern Time on March 16, 2026. Right now, as we're recording this, gold XAU USD spot gold is trading at $5,000.09 per ounce, up just 0.06% on the day, but coming off a sharp pullback from recent highs above $5,400. It's currently testing that critical $5,000 psychological support level, and whether it holds or breaks will be one of the biggest stories of the day. New York gold futures are down 1.1% at $5,006.10, with a low of $4,970.10 overnight, showing just how much pressure this asset is under right now. Crude oil, Brent crude is trading around $103 per barrel, and WTI is near $99.50, a far cry from just a month ago, when Brent was hovering around $72. The reason? The Middle East crisis has escalated, with the Strait of Hormuz, which carries 20% of the world's crude oil, seeing a 90% plus drop in shipping traffic. Gulf countries have cut production by over 10 million barrels per day, and storage facilities are filling up, forcing further cuts. This is the largest supply disruption in the history of the global oil market, and it's not showing any signs of slowing down. Bitcoin, BTC USD Bitcoin is trading at $70,650, down 3.2% in the last 24 hours, with a range of $69,800 to $74,000. The market is volatile, with global contract liquidations affecting 80,000 traders, and is running high. But there's a silver lining: institutional holdings are providing support, with Binance holding 73.87 million BTC at an average cost of $75,862, meaning the current price is below their cost basis, so short-term selling pressure is limited. Also, the 2,000th million Bitcoin has been mined, increasing supply scarcity and fueling the halving effect at US dollar. DXY, the dollar index, is trading at 104.1, up 0.62% on the day, near 4-month highs. The Fed has been signaling a higher for longer stance on interest rates, with rate cut expectations pushed back to September or December. This, combined with safe haven flows amid global market volatility, is driving the dollar higher, and that's putting pressure on all three of the other assets we're covering today. Today is also a big data day, which adds another layer of volatility. We have U.S. economic data coming out later: the New York Fed Manufacturing Index at 20:30 Eastern Time, industrial production at 21:15 Eastern Time, and the NAB Housing Market Index at 10 p.m. Eastern Time. We also have Chinese economic data this morning: 1 to 2 month retail sales and industrial production, which will impact global demand outlook, especially for oil and commodities. And Canada's CPI data at 20:30 Eastern Time could also move the dollar, as it affects Fed policy expectations. So, to sum it up, today is a day of critical levels, key data releases, and geopolitical risks. By the end of this video, you'll know exactly which levels to watch for each asset, what could trigger a breakout or breakdown, how the Fed and geopolitics are influencing the markets, and what your trading strategy should be for the rest of the day. We're going to take our time, dive deep into each asset, and make sure you leave with the confidence to navigate today's volatile markets. But first, before we get into the analysis, we have to cover our official disclaimer. This is non-negotiable. And it's important that you listen closely, because trading involves risk, and we want you to stay safe. Alright, let's get the disclaimer out of the way. This is required by law, and it's for your protection. This material is for educational and informational purposes only. It is not investment advice, financial advice, trading advice, or a recommendation to buy, sell, or hold any security, commodity, cryptocurrency, or financial instrument. Trading and investing involve substantial risk of loss and may not be suitable for all investors. Past performance is not indicative of future results. Always conduct your own independent research, consult a licensed financial advisor, and carefully consider your risk tolerance before making any trading or investment decisions. Market Meridian and its hosts are not responsible for any losses incurred as a result of acting on the information provided in this video. Got it? Good. Now, let's dive into the analysis. Let's start with the US dollar, because it's the backbone of the global financial system, and right now, it's driving the direction of gold, oil, and Bitcoin. If you understand what's happening with the dollar, you'll understand 80% of today's market moves. So, let's break this down step by step, where the DXY is right now, why it's rallying, what's driving it, key levels to watch, and how it will impact the other assets we're covering. First, current levels. As of right now, the dollar index, DXY, is trading at 104.1, up 0.62%. On the day, it closed at 103.45 yesterday, so we've seen a strong rally overnight and into this morning. The DXY is a basket of currencies that measures the dollar's strength against 6 major peers: the euro, 57.6% of the index, Japanese yen, 13.6%, British pound, 11.9%, Canadian dollar, 9.1%, Swedish krona, 4.2%, and Swiss franc, 3.6%. So, when the DXY goes up, it means the dollar is getting stronger relative to these currencies, and that has a ripple effect across all global assets. Now, why is the dollar rallying? There are 3 main drivers, and we need to break each one down because they're all critical to today's outlook. To number 1. Fed policy repricing. Let's start with the biggest driver, the Federal Reserve. Just last week, on March 11th, the Fed released its latest policy statement, and it sent a clear hawkish signal to the markets. The Fed kept interest rates unchanged at 4.25% to 4.50%, which was expected, but they also slowed the pace of their balance sheet reduction, QT, starting April 1st, cutting the monthly Treasury reduction cap from $250 billion to $50 billion. While this might sound like a dovish move, the dot plot told a different story. 19 Fed officials now expect just 2 rate cuts in 2026, down from previous expectations, and more officials are now leaning toward no cuts at all. The Fed also raised its inflation expectations, citing concerns about persistent price pressures, and lowered its economic growth forecast, a combination that signals higher for longer interest rates. What does this mean for the dollar? Higher interest rates make the dollar more attractive to investors, because they can earn a higher return on dollar-denominated assets like U.S. Treasuries. When the Fed signals that rates will stay higher for longer, investors pour money into the dollar, driving its value up. Right now, the market is pricing in a 99% chance of no rate cut in March, and the first cut is now expected in September or December, a huge shift from just a few months ago, when the market was pricing in a March cut. This repricing is the single biggest driver of the dollar's rally over the past month. Secondly, safe haven flows. The second driver is safe haven demand. Global markets are in a state of uncertainty right now. The Middle East crisis is escalating, with no end in sight. Global economic growth is slowing, according to the Fed's latest forecast, and equity markets are volatile. We saw Asian markets drop this morning, Germany's DAX down 0.6%, Hong Kong's Hang Seng down 0.98%, Tokyo's Nikkei down 1.16%. When investors are nervous, they flock to safe haven assets, and the US dollar is the world's primary safe haven currency. This increased demand for the dollar is pushing its value higher, even as other assets struggle. And third, relative currency weakness. The third driver is weakness in other major currencies. The euro is struggling because the European Central Bank, ECB, is expected to cut rates sooner than the Fed. Possibly as early as June, which makes the euro less attractive relative to the dollar. The Japanese yen is also weak, as the Bank of Japan, BOJ, maintains its ultra-loose monetary policy, keeping interest rates near zero. The British pound is under pressure due to weak economic data in the UK, and the Canadian dollar is being weighed down by lower oil prices. Even though oil is rallying now, it's still below recent highs, and Canada is a major oil exporter. When other currencies weaken, the dollar's strength is amplified now. Let's talk about the technical picture for the DXY, because technical levels are crucial for traders. Let's break down the key support and resistance levels, and what they mean for today's trading. Resistance levels. The first major resistance level is 104.5, this is a 4-month high, and if the DXY breaks above this level, it could trigger a further rally toward 105.0. Breaking 105.0 would be a significant milestone, as it would confirm the dollar's bullish trend and put even more pressure on gold, oil, and Bitcoin. The next resistance after 105.0 is 105.5, but we're unlikely to see that today unless the US economic data is surprisingly strong. Support levels. The first major support level is 103.8, this is the level we tested overnight, and we bounced back from it, which is a bullish sign. If we break below 103.8, the next support is 103.5, and then 103.0. Breaking below 103.0 would signal a short-term pullback in the dollar, which would likely give a boost to gold, oil, and Bitcoin. But right now, the momentum is bullish, so support levels are likely to hold unless we get weak US economic data later today. Now, let's talk about today's data releases and how they will impact the DXY. As I mentioned earlier, we have 3 key US data points coming out today: a New York Fed Manufacturing Index. This index measures the health of the manufacturing sector in New York, and it's a leading indicator of US economic activity. A reading above 0 indicates expansion, while a reading below 0 indicates contraction. The market is expecting a reading of -2.0. If the actual reading is higher than expected, closer to 0 or positive, it will signal strength in the US economy, which would be hawkish for the Fed and bullish for the dollar. If the reading is lower than expected, more negative, it will signal weakness, which would be dovish and could push the dollar lower. US industrial production. This measures the output of US factories, mines, and utilities. The market is expecting a 0.2% month-over-month increase. A higher than expected reading would signal economic strength, bullish for the dollar. A lower than expected reading would signal weakness, bearish for the dollar. NAB Housing Market Index. This measures the confidence of US homebuilders. A reading above 50 indicates optimism, while a reading below 50 indicates pessimism. The market is expecting a reading of 48. If it's above 48, it would signal improving housing market sentiment, which is bullish for the dollar. If it's below 48, it's bearish. We also have Canada's CPI data at 20:30 Eastern Time. Canada is a major trading partner of the US, and its inflation data can impact the US dollar, since the Fed pays attention to global inflation trends. If Canada's CPI is higher than expected, it could signal global inflationary pressures, which would be hawkish for the Fed and bullish for the dollar. If it's lower than expected, it could be dovish. Now, let's connect the dots. How does the dollar's movement impact the other assets we're covering today? This is critical, so pay close attention. Gold. Gold is a non-yielding asset, which means it doesn't pay interest. When the dollar is strong, it takes more of other currencies to buy gold, which reduces demand for gold. Also, when US interest rates are high, investors can earn a higher return on treasuries than on gold, so they sell gold to buy treasuries. So, a stronger dollar equals lower gold prices, and vice versa. That's why gold is currently under pressure. The dollar is rallying, and interest rates are high. Crude oil. Oil is priced in US dollars globally. When the dollar is strong, it takes more of other currencies to buy oil, which reduces demand for oil, especially from countries that don't use the dollar. This can cap oil prices, even if there's a supply shortage, like we have now with the Middle East crisis. So, the dollar's strength is currently limiting how high oil can go, even though supply is tight. Bitcoin. Bitcoin is increasingly being traded as a risk asset, which means it moves in the opposite direction of the dollar and other safe haven assets. When the dollar is strong, investors tend to sell risk assets, like Bitcoin, and buy safe havens, like the dollar and treasuries. So, a stronger dollar equals lower Bitcoin prices, which is why BTC is down today. To sum up the US dollar outlook for today, the DXY is in a bullish trend, trading near 4-month highs, driven by Fed hawkishness, safe haven flows, and relative currency weakness. The bias is bullish, but we're near resistance at 104.5, so we could see a pullback if the US data is weak. If the data is strong, we could break above 104.5 and head toward 105.0. Either way, the dollar's movement will be the key driver of gold, oil, and Bitcoin today. Keep a close eye on the 103.8 support level. If we break below that, it's a sign the dollar's rally is losing momentum, and the other assets could get a boost. Alright, let's move on to gold, one of the most watched assets today, as it's teetering at a critical support level of $5,000 per ounce. Gold has been in a strong bull trend over the past year, hitting all-time highs above $5,400 just a few weeks ago, but it's pulled back sharply in recent days, and now it's testing that $5,000 psychological support. Today, we're going to break down why gold is pulling back, whether $5,000 will hold, what the key levels are, and what your trading strategy should be for. Gold today first, let's get the current data straight. As of right now, spot gold, XAUE USD, is trading at $5,000.09 per ounce, up 0.06% on the day. It hit a low of $4,981.94 overnight, which is just below the $5,000 level, but it bounced back slightly. New York gold futures are down 1.1% at $5,006.10, with a low of $4,970.10, showing that there's still significant selling pressure. Meanwhile, domestic gold markets are also under pressure. Shanghai gold T+D is down 2% at 1,113.8 yuan per gram, and Shanghai gold futures are down 2.3% at 1,115.4 yuan per gram. Silver is also down across the board, which is a bearish sign for the precious metals complex. London silver is down 1.27% at $79.066 per ounce, and Shanghai silver T+D is down 6.35% at 19,966 yuan per kilogram. Now, let's break down the reasons for gold's recent pullback. There are 4 main factors, and they're all interconnected. Reason 1. Strong US dollar. As we discussed earlier, the US dollar is rallying to 4-month highs, and gold and the dollar have an inverse relationship. When the dollar is strong, gold becomes more expensive for investors using other currencies, which reduces demand. This is the single biggest driver of gold's pullback right now. The DXY is up 0.62% today, and that's putting significant pressure on gold. Reason 2. Higher US interest rates and Fed hawkishness. Gold is a non-yielding asset, so when US interest rates are high, investors can earn a higher return on interest-bearing assets like US Treasuries, CDS, and savings accounts. This makes gold less attractive, so investors sell gold to buy these high-yielding assets. The Fed's recent hawkish signals, pushing rate cuts back to September-December and raising inflation expectations, have made this even worse. The 10-year US Treasury yield is currently above 4.25%, which is near multi-month highs, and that's a major headwind for gold. And 3. Fading safe haven premium. Gold is often seen as a safe haven asset, and it rallied earlier this year due to the Middle East crisis. However, in recent days, the crisis has cooled slightly, though it's still very serious, and investors have shifted some of their safe haven flows from gold to the US dollar and treasuries. This has reduced the safe haven demand for gold, putting downward pressure on prices. That said, the crisis is far from over, so the safe haven premium could return at any time if tensions escalate again. And the most important reason is profit-taking. Gold had a massive rally from $4,500 to $5,400 in just a few months, so many investors are taking profits now, which is adding to the selling pressure. When an asset hits all-time highs, profit-taking is common, and that's exactly what we're seeing with gold right now. Traders who bought gold at lower levels are selling to lock in their gains, which is pushing prices lower. But it's not all bearish for gold. There are some strong bullish factors that are supporting prices and could prevent a further collapse. Let's break those down, because they are crucial to understanding why $5,000 is such an important support level. Central bank buying. This is the strongest long-term support for gold. The World Gold Association reports that global central banks have been net buyers of gold for 15 consecutive years, and they've bought over 1,000 tons of gold for 3 years in a row. 95% of central banks plan to continue increasing their gold holdings in the coming years. Why? Because central banks are looking to diversify their reserves away from the US dollar, especially amid growing concerns about US debt and dollar creditworthiness. This consistent central bank buying acts as a floor for gold prices. It means that even if prices pull back, central banks will step in to buy, preventing a sharp collapse. For example, when gold fell to $4,980 overnight, central bank buying likely kicked in, pushing prices back up to $5,000. Long-term bullish sentiment. Many major financial institutions are still bullish on gold for 2026. Goldman Sachs has a target of $5,400, UBS has a target of $6,200, and JP Morgan Chase has a target of $6,300. Senior analyst even believes that in an extreme scenario, gold could hit $7,000 per ounce in 2026, driven by dollar weakness, geopolitical risks, and central bank buying. This institutional bullishness means that many investors are viewing the current pullback as a buying opportunity, which is providing support at $5,000. Technical support at $5,000. The $5,000 level is not just a psychological support, it's also a technical support level. Looking at the daily chart, gold has tested this level multiple times over the past few weeks, and it has held each time. This means that traders are placing buy orders at $5,000, expecting the level to hold. If it does hold today, it could signal the end of the pullback and a resumption of the bull trend. If it breaks, however, it could trigger further selling. Now, let's dive into the technical analysis for gold, including key support and resistance levels, and the short-term bias support levels. The most critical support level is $5,000. This is the psychological and technical support we've been talking about. If gold breaks below $5,000, the next support level is $4,950. This is a key technical level, as it was a resistance level earlier this year, and now it's support. If we break below $4,950, the next support is $4,900, and then $4,850. But I don't expect us to get that low today, unless the US economic data is surprisingly strong, which would push the dollar higher and gold lower. Resistance levels. The first major resistance level is $5,050. This is the level we tested yesterday, and we couldn't break above it. If we can break above $5,050, the next resistance is $5,080, and then $5,100. Breaking above $5,100 would signal that the pullback is over and that the bull trend is resuming. The next major resistance after that is $5,200, and then the all-time high of $5,400. Short-term bias. The short-term bias for gold is neutral to bearish, due to the strong dollar and Fed hawkishness. However, the $5,000 support level is holding, and central bank buying is providing support. So, we're likely to see a range-bound trade today, between $4,980 and $5,050. If the US data is weak, which would push the dollar lower, gold could rally toward $5,080 to $5,100. If the data is strong, which would push the dollar higher, gold could break below $5,000 and test $4,950. Now, let's talk about today's key triggers for gold, what events could move the price, and how you should react. 1. U.S. economic data. As we discussed earlier, the New York Fed Manufacturing Index, Industrial Production, and NARB Housing Market Index will all impact the dollar, which in turn impacts gold. If the data is strong, dollar up, gold down. If the data is weak, dollar down, gold up. This is the biggest trigger for gold today, so make sure you're watching these data releases at 20:30, 21:15, and 22:00 ET.2. Middle East headlines. Any escalation in the Middle East crisis could reignite safe haven demand for gold, pushing prices higher. For example, if there's a new attack on oil infrastructure, or if the US or Israel takes further military action, gold could rally sharply. Conversely, if tensions ease, gold could come under further pressure. Point 3. Technical breakout or breakdown. If gold breaks above $5,050, it's a bullish signal, and you could consider a long position with a stop loss below $5,000. If gold breaks below $4,980 and stays below, it's a bearish signal, and you could consider a short position with a stop loss above $5,000. The key is to wait for the breakout or breakdown to confirm. Don't jump the gun, because false breakouts are common in volatile markets now. Let's talk about trading strategies for gold today. Depending on your trading style as scalpers, look for range-bound trading between $4,980 and $5,050. Buy near $4,980 to $5,000, sell near $5,040 to $5,050. Use tight stop losses, $5 to $10, to limit risk. Scalping is risky in volatile markets, so make sure you're using proper risk management. Day traders, wait for a confirmed breakout or breakdown. If gold breaks above $5,050, go long with a target of $5,080 to $5,100 and a stop loss below $5,000. If gold breaks below $4,980, go short with a target of $4,950 to $4,940 and a stop loss above $5,000. Don't trade until the breakout or breakdown is confirmed. False breakouts are common here. Swing traders, the current pullback is likely a buying opportunity for swing traders, as the long-term bull trend is still intact. Consider buying near $4,980 to $5,000, with a stop loss below $4,950 and a target of $5,200 to $5,400. This is a longer-term trade, so be prepared to hold for a few days or weeks. Long-term investors, ignore the short-term volatility and focus on the long-term fundamentals. Central bank buying, dollar weakness, long-term, and geopolitical risks are all bullish for gold. If you're a long-term investor, the current pullback is a great opportunity to add to your position. Consider buying physical gold, gold ETFs like GLD, or gold mining stocks. Let's also address some common questions we get about gold. Will $5,000 hold? Is the bull trend over? Should I sell my gold now? Will $5,000 hold? I think it's likely to hold today, especially with central bank buying and technical support. However, if the US data is surprisingly strong, we could see a temporary break below $5,000, but I expect it to bounce back quickly. The $5,000 level is too important for traders and central banks to let it break easily. Is the bull trend over? No, the long-term bull trend is still intact. The pullback we're seeing is a normal correction in a bull market. The fundamentals are still bullish: central bank buying, dollar creditworthiness concerns, geopolitical risks, and Fed rate cuts, eventually. The current pullback is a chance to buy, not sell. Should I sell my gold now? If you're a short-term trader, you might want to take profits if you bought near $4,500 to $4,800. But if you're a long-term investor, there's no reason to sell. The long-term outlook for gold is bullish, and the current pullback is temporary. To sum up the gold outlook for today, gold is testing the critical $5,000 support level, with bearish pressure from the strong dollar and Fed hawkishness, but bullish support from central bank buying, technical levels, and long-term institutional sentiment. The bias is neutral to bearish in the short term, but the long-term trend is still bullish. Watch the US economic data closely, it will be the key driver of gold's movement today. If $5,000 holds, we could see a rally toward $5,080 to $5,100. If it breaks, we could test $4,950. Either way, use proper risk management, and don't let short-term volatility cloud your long-term perspective. Next up, crude oil, the asset that's been most affected by the Middle East crisis, and one that's seeing extreme volatility right now. Brent crude is trading around $103 per barrel, WTI is near $99.50, and the market is on edge due to the worst supply disruption in history. Today, we're going to break down the current supply and demand dynamics, the impact of the Hormuz Strait crisis, key levels to watch, and what your trading strategy should be for oil today. First, let's get the current data straight. As of right now, Brent crude is trading at $103.20 per barrel, up 1.2% on the day. WTI crude is trading at $99.60 per barrel, up 1.5% on the day. Both benchmarks have rallied sharply over the past month. Brent is up over $30 per barrel since mid-February, and WTI is up over $25 per barrel. This rally is being driven by a massive supply shortage, caused by the Middle East crisis and production cuts. Overnight, Brent hit a high of $104.50, and WTI hit a high of $100.80, but they pulled back slightly as the US dollar rallied. This shows the tug-of-war between supply shortages, bullish, and a strong dollar, bearish, that's currently driving oil prices now. Let's dive into the biggest driver of oil prices right now, the Middle East crisis and the disruption to the Strait of Hormuz. This is the most critical factor, so we need to break it down in detail. The Strait of Hormuz is a narrow waterway in the Persian Gulf that connects the Gulf to the Arabian Sea. It's the most important oil shipping route in the world, carrying approximately 20% of the world's crude oil and 30% of the world's refined oil products. Before the Middle East crisis escalated, around 20 million barrels of oil per day, MBRD, passed through the strait. Now, that number has plummeted to a trickle, less than 2 million barrels per day, due to attacks on oil infrastructure and the cessation of tanker traffic. This is the largest supply disruption in the history of the global oil market, and it's getting worse. To make matters worse, Gulf countries, including Saudi Arabia, Iran, and the UAE, have been forced to cut oil production by at least 10 million barrels per day. Why? Because their storage facilities are filling up. With tanker traffic through the Strait of Hormuz nearly at a standstill, they have nowhere to export their oil, so they're forced to cut production to avoid overflowing their storage. This has further reduced global oil supply, pushing prices higher. The IEA, International Energy Agency, estimates that global oil supply will plunge by 8 million barrels per day in March, with the Middle East cuts only partially offset by higher output from non-OPEC Plus producers like Kazakhstan and Russia. The IEA has tried to mitigate the supply shortage by releasing 400 MB of oil from emergency reserves, but this is a temporary fix. Global observed oil stocks were 8,210 MB in January, their highest level since February 2021, but the supply shortage is so severe that these reserves will only last a few weeks. The OECD holds 50% of these stocks, China holds 15%, and 25% is oil on water, tankers waiting to unload. Once these reserves are depleted, the supply shortage will worsen, and oil prices could surge even higher. Another factor contributing to the supply shortage is the shutdown of refining capacity in the Middle East. More than 3 million barrels per day of refining capacity in the region has already been shut down due to attacks and a lack of viable export outlets. This means that even if oil production resumes, there won't be enough refining capacity to process it into usable products like gasoline and diesel, which will further tighten the market. Refining capacity elsewhere in the world is also limited due to feedstock availability, so this problem isn't going away anytime soon. Now, let's talk about demand dynamics, because demand is also playing a role in oil prices. The IEA has revised down its global oil demand forecast for 2026, due to the Middle East crisis and higher oil prices. Widespread flight cancellations in the Middle East and large-scale disruptions to LPG supplies are expected to curb global oil demand by around 1 million barrels per day during March and April. Higher oil prices are also reducing demand, as consumers and businesses cut back on fuel usage. Global oil consumption is now set to increase by 640 kbd year-over-year in 2026, down 210 kbd from last month's forecast. However, demand is still growing, and the supply shortage is far larger than the demand reduction, which is why prices are still rallying. Now, let's break down the other key drivers of oil prices to date. 1. US dollar strength. As we discussed earlier, oil is priced in US dollars, so a strong dollar reduces demand for oil from countries that don't use the dollar. This is currently capping oil prices, even though supply is tight. If the dollar rally continues, it could prevent oil from hitting $110 per barrel, Brent, in the short term. If the dollar pulls back, however, oil could surge higher. 2. OPEC Plus policy. OPEC+, the Organization of the Petroleum Exporting Countries and its allies, has maintained its production cut policy, with no plans to increase production. This is bullish for oil prices, as it reduces supply and supports prices. OPEC+ has been very disciplined with its production cut policy over the past few years, and it's unlikely to change course now, especially with the Middle East crisis ongoing. Point 3. U.S. shale oil production. U.S. shale oil production is currently at 13.7 million barrels per day, but it's not increasing. Rig counts are declining, and oil companies are focusing on capital discipline, returning profits to shareholders rather than increasing production. This means that U.S. shale oil won't be able to offset the Middle East supply shortage, which is bullish for oil prices. Even if oil prices hit $120 per barrel, U.S. shale oil production is unlikely to increase significantly in the short term. Point 4. Geopolitical risks. The Middle East crisis is far from over, and any escalation could push oil prices higher. For example, if there's a new attack on oil infrastructure, or if the US or Israel takes further military action, oil could surge above $110 per barrel. Conversely, if tensions ease, e.g., a ceasefire is announced, oil could pull back. But right now, the crisis is escalating, so the geopolitical risk premium is likely to remain high now. Let's dive into the technical analysis for Brent and WTI, including key support and resistance levels. Brent crude, current price, $103.20 resistance levels. The first major resistance level is $104.50, the overnight high. If Brent breaks above this level, the next resistance is $108 to $110. Breaking above $110 would open the door to $115 to $120, which is the level we saw earlier this month before prices pulled back. The all-time high for Brent is $147 per barrel, set in 2008, so there's plenty of room for further gains if the supply shortage worsens. Support levels. The first major support level is $100 per barrel, psychological support. If Brent breaks below $100, the next support is $98 per barrel. This is a key technical level, as it was a resistance level earlier this month. If we break below $98, the next support is $95 per barrel, and then $92 per barrel, the level we saw last week. But I don't expect us to get that low today, unless there's a major de-escalation in the Middle East. WTI crude, current price, $99.60 resistance levels. The first major resistance level is $100.80, the overnight high. Breaking above $100.80 would open the door to $104 to $105 per barrel. The next resistance after that is $108, $110 support levels. The first major support level is $98 per barrel. If WTI breaks below $98, the next support is $97 per barrel, and then $95 per barrel. Breaking below $95 would signal a short-term pullback, but the long-term trend is still bullish. Short-term bias. The short-term bias for both Brent and WTI is bullish, due to the supply shortage and geopolitical risks. However, the strong dollar is capping gains, so we're likely to see a range-bound trade today, with Brent trading between $100 to $104.50 and WTI trading between $98 to $100.80. If the Middle East crisis escalates, we could break above resistance and rally higher. If the US dollar strengthens further, we could test support levels. Now, let's talk about today's key triggers for oil prices. 1. Middle East headlines. This is the biggest trigger. Any new attacks on oil infrastructure, tanker traffic, or military action will push oil prices higher. Any news of a ceasefire or de-escalation will push prices lower. Make sure you're monitoring breaking news from the Middle East throughout the day. Point 2. U.S. economic data. The U.S. economic data, New York Fed Manufacturing Index, industrial production, will impact the dollar, which in turn impacts oil prices. Strong data equals stronger dollar equals lower oil prices. Weak data equals weaker dollar equals higher oil prices. Point 3. Chinese economic data. China is the world's largest oil importer, so its economic data, 1 to 2 month retail sales and industrial production, released earlier today, will impact global oil demand. If China's data is strong, it signals higher demand for oil, which is bullish. If it's weak, it signals lower demand, which is bearish. Earlier today, China's 1 to 2 month retail sales were slightly below expectations, which put some downward pressure on oil prices, but the supply shortage is overriding that. Point 4. Technical breakdown. If Brent breaks above $104.50, it's a bullish signal, and you could consider a long position with a stop loss below $100. If Brent breaks below $100, it's a bearish signal, and you could consider a short position with a stop loss above $104.50. The same applies to WTI. Break above $100.80 equals long, break below $98 equals short. Now, let's talk about trading strategies for oil today. Depending on your trading style as scalpers, look for range-bound trading between $100 to $104.50, Brent, and $98 to $100.80, WTI. Buy near support, sell near resistance. Use tight stop losses, $1 to $2 per barrel, to limit risk. Oil is very volatile, so scalping is risky. Only trade with money you can afford to lose. Day traders, wait for a confirmed breakout or breakdown. If Brent breaks above $104.50, go long with a target of $108 to $110 and a stop loss below $100. If Brent breaks below $100, go short with a target of $98 to $95 and a stop loss above $104.50. For WTI, break above $100.80 equals long, target $104 to $105, break below $98 equals short, target $97 to $95. Swing traders, the long-term trend for oil is bullish, so the current pullback, if any, is a buying opportunity. Consider buying Brent near $100 to $102, with a stop loss below $98 and a target of $110 to $115. This is a longer-term trade, so be prepared to hold for a few days or weeks. Long-term investors, if you're a long-term investor, consider investing in oil stocks, oil ETFs, like USO, or oil futures. The supply shortage is likely to persist for months, if not years, so oil prices are likely to remain high. However, be aware that oil is a volatile asset, so use proper risk management and don't invest more than you can afford to lose. Let's address some common questions about oil. Will oil hit $120 per barrel? Is the supply shortage temporary? Should I buy oil now? Will oil hit $120 per barrel? Yes, it's very likely, especially if the Middle East crisis escalates further. The supply shortage is severe, and the IEA's emergency reserves will only last a few weeks. If the Strait of Hormuz remains closed, oil could hit $120 to $130 per barrel in the coming weeks. Is the supply shortage temporary? No, the supply shortage is not temporary. In fact, it's likely to worsen before it gets better. The Middle East crisis shows no signs of abating, and the Strait of Hormuz disruption could last for months. Even if tensions ease, Gulf countries will take time to restart production and clear their storage backlogs, and refining capacity that's been shut down won't come back online overnight. Additionally, OPEC+'s disciplined production cut policy and stagnant U.S. shale production mean there's no quick fix to boost global supply. The IEA has warned that the supply gap could widen in the second quarter of 2026. All above are the key trading analysis and strategies for today. Thank you for watching. PLS subscribe my channel for more update information. Safe trading. I am Eric from Market Meridian.